Right now, there are two prices for silver. One is printed on your screen, the other is what people are actually paying to hold it in their hands. And the gap between those two numbers just hit a level that historically has only appeared 3 times in the last 40 years, and every single time it appeared, silver didn't stay quiet for long. The spot price on COMEX this week is sitting near $32 an ounce. But walk into a major dealer, online or in person, and you're paying $38, $39, sometimes $40 for a single 1-ounce silver eagle. That's a premium of more than 20% above the so-called official price. In a normal functioning market, that spread would be arbitraged away within hours. Dealers would flood supply to close the gap, but the gap didn't close. It widened. That's not volatility. That's a signal. You're watching this because the mainstream financial media won't show you what that signal means. They'll talk about the Federal Reserve. They'll talk about inflation data. They'll debate whether silver is a safe haven or a risk asset, but they will not sit down and explain why the paper price and the physical price are diverging at the exact same time that registered inventories at COMEX are falling. Again. So let's do that right now, because once you understand the ratio, the price action makes sense. Start with the inventory numbers. As of the most recent COMEX Vault report, registered silver, that's the metal that is actually available to deliver against futures contracts, not just eligible metal sitting in a vault, stands at approximately 130 million ounces. That sounds like a lot. Until you compare it to open interest on silver futures contracts, right now, open interest on COMEX silver is equivalent to roughly 750 million ounces of silver, 750 million ounces of paper claims backed by 130 million ounces of physical metal. That's a coverage ratio of less than 1 to 5. Paper says one thing, the vault says something very different. Now here's where most analysts stop. They say, oh, futures markets always operate with fractional backing. That's normal. And technically, yes, most futures participants never intend to take delivery. They're hedging, speculating, rolling positions. The market has functioned this way for decades. But that's not the part that should concern you. What should concern you is the direction of that ratio, because it's not stable. It's moving, and it's moving the wrong way. In early 2021, registered inventories at COMEX hit approximately 150 million ounces. By 2022, they dropped under 90 million. They partially recovered. And now they're declining again, even as open interest remains elevated. The pile of paper claims is staying the same size. The pile of physical metal backing those claims is shrinking. Someone is pulling physical silver out of the COMEX system, consistently. Quarter after quarter. The question is who? And the more important question is why now? Let me give you one more number before we get into that, because this number is the one that woke me up when I first saw it. The Shanghai Futures Exchange, China's primary silver futures market, is currently pricing silver at a premium of between 8 and 12% above London spot on a currency-adjusted basis. 8 to 12%. That means buyers in Shanghai are voluntarily paying more for silver than buyers in London or New York. In commodity markets, when the same product trades at 2 different prices in 2 different locations simultaneously, that is called an arbitrage opportunity. And in a free market, arbitrageurs instantly flood the cheaper market with buy orders and the premium collapses. It doesn't persist for weeks. It doesn't persist for months. The Shanghai premium has been holding for most of the last 18 months. Once you understand the ratio, the price action makes sense. Wall Street is not confused. They know exactly what this means. And if you stay with me through the next 14 minutes, you will too. If this kind of structural analysis is what you're looking for, the real numbers, the vault data, the COMEX mechanics that mainstream finance never explains, then subscribe to The Hidden Economy right now. Hit that bell, because we cover this every week, and the story is accelerating. Let's keep going. Now I need you to understand something about how the COMEX silver market actually works, because this is the architecture behind everything I'm about to show you. COMEX is run by the CME Group, Chicago Mercantile Exchange. It is the primary futures exchange where the global price of silver is set. Every day, billions of dollars worth of paper silver contracts trade on that exchange. These contracts represent 5,000 ounces of silver each. And here's the critical part. The vast majority, we're talking 98 to 99%, of these contracts are never settled with actual physical metal. They're cash settled, rolled forward, or closed before delivery month arrives. This system works fine as long as confidence holds. As long as every participant believes that, if they ever did want to take delivery, the metal would be there. The moment that confidence breaks, the moment a meaningful number of contract holders decide they want the physical metal instead of the paper, the entire structure is stress tested in a way that hasn't happened in modern memory. And the data suggests that stress test may already be quietly underway. Here are the 5 data points that form the pattern. Walk through each one with me carefully. Data point 1. COMEX registered silver inventories have dropped by over 40% from their 2021 peak. From roughly 150 million ounces to approximately 130 million ounces today, with a trough near 88 million ounces in between. That's not noise. That is a structural drain. Data point 2. Physical silver premiums at retail have stayed elevated for over 2 years. In a genuinely oversupplied market, which is what the paper price implies, premiums collapse. Dealers discount. Supply floods in. That has not happened. The premium held through the entire dump in late 2023. The premium held through the sell-off in early 2024. The premium held through every paper price smash. Paper says one thing, The market, the actual buying and selling of real metal by real people, says something very different. Data point 3, the U.S. Mint has repeatedly reported production constraints and allocation limits on silver eagles, the most widely purchased silver coin in the world. This is the official mint of the United States government telling you they cannot keep up with demand. Not a shortage of orders, a shortage of supply capacity, at the same time that COMEX is telling you silver is abundant. Data point 4, India imported a record volume of silver in 2023, approximately 9,500 tons. To put that in perspective, global annual silver mine supply is roughly 25,000 tons. India alone absorbed nearly 38% of annual mine production in a single year, and they didn't stop. 2024 import data shows the trend continuing. Where did all that silver go? Into the ground, into private hands, out of the Western paper market system. Data point 5, central bank and sovereign wealth positioning. While Western ETFs, products like SLV and PSLV, saw outflows or flat flows throughout much of 2023 and early 2024, Eastern demand at the physical level didn't just hold, it accelerated. This is the East versus West divergence in its purest form. The West is still pricing silver like 2019, the East is accumulating like it's 1979. Same playbook, different decade. And here's what should really disturb you. This exact pattern, physical drain from Western vaults, Eastern premium persistence, retail supply constraint, paper price suppression, appeared before both of the two great silver price explosions in modern history. Before 1980, when silver ran from under $5 to $50 in roughly 18 months. And before 2011, when silver ran from $18 to $49 in under a year. Once as accident, twice as coincidence. 3 times as policy. But that's not the part that should concern you most. What should concern you is the role of the dominant institutional players in this market, and the documented history of how they've used paper contracts to manage price. In 2020, JPMorgan Chase & Co. reached a $920 million settlement with the U.S. Department of Justice related to what prosecutors described as a massive multi-year scheme to manipulate the market for precious metals futures contracts. $892 million. Admitted to, settled. Not disputed. The scheme involved a practice called spoofing, placing large buy-or-sell orders with the intention of canceling them before execution, creating the illusion of supply or demand to move the price in a desired direction. It also involved what regulators described as layering, stacking multiple fake orders to amplify the effect. This was not an isolated trader going rogue. This was described as organized, systematic, and running for years across a team of traders. Now here's what nobody is talking about. The settlement didn't include an admission that the underlying price level was wrong. It didn't include restitution to the millions of physical silver holders whose metal was arguably underpriced during the manipulation period. It resulted in fines. Fines that were essentially a rounding error against the profits generated. Wall Street is not confused. They know exactly what a $920 million settlement for a multi-year scheme in a multi-trillion-dollar market means. It means the fine was the cost of doing business. And it means the incentive structure that made the manipulation profitable was never dismantled. Here's what they filed at close of business on a Friday that nobody is talking about. The Commodity Futures Trading Commission's Commitment of Traders report consistently shows that the commercial trader category, dominated by the largest banks, holds net short positions in silver futures that dwarf any other category of participant. As of the most recent COT report, commercial net short positions stand at approximately 60,000 contracts. 60,000 contracts, each representing 5,000 ounces. That is 300 million ounces of short exposure. There are not 300 million ounces of registered silver available to deliver against those shorts. This number doesn't exist in a fair market. Why did JPMorgan reclassify 13 million ounces overnight in their last major vault adjustment? How can 750 million paper ounces of open interest coexist with 130 million registered physical ounces, and anyone still call this a functioning market? And what happens to the holders of those 300 million ounces of commercial short positions if a meaningful portion of the long side simultaneously demands delivery? These are not rhetorical questions. They are structural questions about market architecture, and they have no comfortable answers. There's one more layer to this pattern that I need you to understand before we get to what comes next, and this is where the $150 number stops sounding like fantasy. Silver has what analysts call a gold to silver ratio. Right now that ratio sits at approximately 88 to 1. That means it takes 88 ounces of silver to buy 1 ounce of gold. The historical average going back centuries is roughly 50 to 1. In 2011, at peak silver prices, the ratio compressed to 32 to 1. In 1980, it briefly touched 17 to 1. Gold is currently trading near $300 an ounce. If the gold to silver ratio simply reverted to its long-term historical average of 50 to 1, silver would trade at $62 an ounce. If it compressed to 2011 levels, 32 to 1, silver trades at $97 an ounce. If it approached 1980 levels, and the structural conditions right now are arguably more extreme than 1980, silver trades at 182 an ounce. The $150 target that the title of this video references isn't a random number pulled from optimism. It's the mathematical output of a gold to silver ratio of approximately approximately 20 to 1, which remains above the 1980 historic compression point applied to current gold prices. Is $150 guaranteed? Absolutely not. This is not financial advice. Your money, your decisions. But here's the question that keeps me up at night. In what scenario does silver stay at $30 while gold trades above $3,000, when every historical precedent, every structural data point, every vault inventory trend, and every Eastern premium signal is pointing the same direction? If you're finding this analysis valuable, if this is the kind of data layering you've been looking for and not finding anywhere else, subscribe right now. Leave a comment telling me your silver target for 2026. I read every single one. Because we're getting to the part of this story that the channel was built for. Let me talk about who gets hurt when this resolves. Because it will resolve. Markets always resolve. The question is never whether the gap between paper price and physical reality closes. The question is how fast, in which direction, and who is holding what when it does. There are three types of people watching this video right now. Type 1 is watching their silver position and feeling anxious. The price has been frustrating. They've been hearing about silver's potential for years. They bought at $26 or $28 or $30, and the price has moved, but not in the way or at the speed they expected. Type 1 is starting to wonder if they were wrong. Type 1 say the Dekax is the most vulnerable person in this market, not because they made a bad decision, but because they're about to make a bad one in response to frustration and impatience. Type 2 is watching from the sidelines. They've heard the arguments. They're not fully convinced. They've been burned before by this is the moment narratives. They're waiting for more confirmation. Type 2 is going to wait until the move is already 40% underway, then buy at the worst possible entry point out of fear of missing out. Type 3 understands that the data doesn't care about their emotions or their timeline. Type 3 has studied the vault numbers. Type 3 knows what a declining coverage ratio means. Type 3 is not excited about a silver price explosion. They're prepared for one. Preparation and excitement are very different postures. Excitement leads to over-leveraging, over-concentration, and panic at the first pullback. Preparation leads to position sizing, patience, and staying power. You're watching this video. You're in the data. You are most likely Type 3. Act like it. Now let me be direct about the implications, the real ones, not the cheerleading version. If the COMEX paper-to-physical ratio continues to deteriorate and a delivery squeeze develops, the initial price response will not be orderly. It will not be gradual. The history of commodity squeezes, from the Hunt brothers in 1980 to the nickel squeeze on the LME in 2022, shows that when the market realizes the physical backing is insufficient, prices don't drift up 10%. They gap, they spike, they create conditions where the CME Group has historically done something very specific and very damaging to the retail investor. They raise margin requirements. In 2011, as silver approached $50 an ounce, the CME Group raised silver futures margin requirements 5 times in 9 trading days. 5 times. Each margin hike forced leveraged longs to liquidate their positions. Each liquidation hammered the paper price lower. Silver fell from $49 to $35 in 2 weeks. The paper price collapsed. But here's what the cheerleaders never tell you and what the narrative managers desperately want you to forget. The physical premium didn't collapse with it. In the weeks after the 2011 margin hike-driven crash, dealers were still charging $3 to $5 per ounce premiums on physical silver. Because the buyers of real metal, the people who wanted to hold it, not trade it, didn't care what happened on COMEX that week. The premium held through the entire dump. It held in 2011. And the data strongly suggests it's holding now. This is the critical distinction that separates the people who understand this market from those who don't. The paper price and the physical price are not the same thing. They are connected loosely by the theoretical possibility of delivery. But when delivery becomes difficult, expensive, or uncertain, that connection weakens, and in extreme conditions, it can break. We're watching the connection weaken right now in real time. Here's what that means practically. If you hold physical silver, coins, bars, allocated storage, the paper price on your screen is increasingly a fiction with respect to what you actually own. Because what you actually own cannot be conjured from nothing. It exists. It has weight. It has industrial applications that are themselves accelerating. And that's the layer of this story that most precious metals channels completely ignore. Silver is not just a monetary metal. It is an industrial input in a way that gold simply is not. Approximately 55 to 60% of annual silver demand comes from industrial applications. Solar panels, electric vehicles, electronics, medical devices, defense technology. The green energy transition, regardless of where you stand politically on climate policy, that is a physical silver consumption story. Each standard solar panel requires approximately 20 grams of silver. Global solar installation targets for 2025 and 2026 alone imply silver demand that is running well ahead of mine supply growth. Mine supply. Let's talk about that for a moment. Silver mines are not being built fast enough. The lead time from discovery to production for a new silver mine is typically 10 to 15 years. The capital investment required is enormous. And here's the cruel mathematics of the situation. Approximately 72% of all silver mined globally comes as a byproduct of mining for other metals: copper, zinc, lead, gold. Silver is not primarily mined for silver. It is extracted as a secondary product of mining activity driven by demand for other commodities. And that means you cannot simply mine more silver in response to a silver price spike. The supply response is slow, capped by the production decisions of copper and zinc miners who are not primarily motivated by silver prices. This is a structural supply constraint that has no quick fix. The West is still pricing this like 2019 and industrial demand is pricing it like 2030. Which one do you think is right? Now, let me give you the scenario where $150 silver doesn't happen. Because I told you I'd address the counter-argument, and I will. The bearish case for silver rests on a few pillars. First, economic slowdown reduces industrial demand. If we hit a severe global recession, solar panel installations slow, EV sales drop, manufacturing contracts, and silver's industrial demand base softens. Second, dollar strengthening. A strong dollar historically pressures dollar-denominated commodity prices. Third, continued paper market dominance. If the paper-to-physical ratio never gets stress-tested, if the current COMEX structure holds and no delivery squeeze materializes, the paper price can theoretically remain disconnected from physical reality indefinitely. These are real risks, and any person sizing a position in silver needs to hold them seriously, but here's what I'll say about each one. On recession and industrial demand, the countries driving the most aggressive solar and EV expansion right now are China and India. Combined, they represent over 8 billion people. They are not slowing down their infrastructure build-out in response to a Western recession. China installed more solar capacity in 2023 alone than the entire rest of the world combined. That is physical silver being consumed. Permanently. On dollar strength, the trend line is longer than 1 quarter. The dollar has lost purchasing power every decade since 1971. The de-dollarization trend, BRICS payment systems, bilateral currency agreements, central bank gold accumulation, is real, documented, and accelerating. A strong dollar in 2024 and 2025 is entirely consistent with a weaker dollar structural trend across the next decade. And on paper market dominance, I just walked you through a $920 million manipulation settlement, declining COMEX registered inventories, a 5-to-1 paper-to-physical coverage ratio, and 18 months of persistent Shanghai premiums. Wall Street is not confused. They know exactly what this means. The paper market's ability to dominate the price signal depends on confidence in the paper market. That confidence is being eroded, data point by data point, vault withdrawal by vault withdrawal. Here's what they filed at 3 a.m. that nobody is talking about. Multiple large commodity trading firms have quietly increased their requests for physical delivery on COMEX over the past 18 months. Not dramatically, not in a way that triggers a front-page story. Incrementally, carefully, strategically. Each delivery reduces registered inventory, each reduction tightens the coverage ratio. The process is gradual until it isn't. The moment that changes, the moment a meaningful institutional player decides to force the issue, or the moment enough medium-sized players simultaneously decide to take delivery, the math becomes unworkable faster than the CME Group can manage it with margin hikes alone. What happens to your savings when the ratio finally collapses? What happens to the paper contract holders who thought they owned silver, but find out their counterparty cannot deliver? What happens to the premium, to the price, to the narrative that this market has been functioning normally for decades? Those questions do not have comfortable answers, and the people who are holding physical silver when that resolution comes, the people who are already Type 3, who already made the decision with patience and position sizing and conviction rooted in data, those people will not be asking those questions. They'll be watching others ask them. Drop a comment right now. Tell me your silver price target for 2026. Is it $50? $75? $100? $150? I want to know, and I want the record. Because I will make a follow-up video and we will see who was right. If you've made it this far and you're not subscribed, fix that right now. Subscribe to The Hidden Economy. This is the kind of structural analysis, the vault data, the ratio mechanics, the institutional positioning that you will not find in the mainstream. And the story is moving. Send this video to one person, one who you think needs to understand what's happening in silver right now. Most people will never see this information. You saw it. Help someone else see it too. Here's where we are. The COMEX coverage ratio sits below 1 to 5. The Shanghai premium has held for 18 months. Registered inventories are declining. Industrial demand is structurally accelerating. Mine supply cannot respond quickly. The West is still pricing silver like 2019, and the documented history of institutional manipulation, settled in court, paid in fines, never structurally remediated, tells you that the current paper price is not a market clearing price. It is a managed number. Paper says $30. The vault says something very different. The premium held through the entire dump. It held in 2011. It's holding now. Once you understand the ratio, the price action makes sense. This is not complicated. It's just information that requires you to look at the actual vault reports, the actual COT data, the actual delivery statistics, instead of accepting the number scrolling across the bottom of a financial news channel as the whole story. The whole story is, something is draining the physical silver market from the inside. Eastern buyers are paying premiums that shouldn't persist in a free market. Industrial demand is consuming silver in ways that mine supply cannot match. And a paper market with a coverage ratio of less than 1 to 5 is one forced delivery event away from a price discovery moment that will be studied in financial textbooks. Wall Street is not confused. They know exactly what this means. The question is whether you do. This number doesn't exist in a fair market. Now here's what I need you to watch for, and this is why you need to be subscribed before the end of this week. The next COMEX first notice day for the silver delivery cycle is approaching at the end of this month. That is the date by which holders of futures contracts who want physical delivery must formally notify the exchange. Watch the registered inventory numbers in the 48 hours following that filing window. If the registered number drops again, if it drops meaningfully 5 million ounces or more in a short window, that is not a coincidence. That is the pattern completing its next step. And the step after that is the one that changes the price.